first story that we're tracking on the show. Well, quick commerce and food delivery, these are the two fast evolving sectors, and both of these segments have been buzzing with action. While Rapido is making its move into the food delivery segment, BigBasket as well is scaling up its cafe play, while established players like Zepto and Blinkit are feeling the regulatory heat. Add to that, there is growing unrest amongst gig workers and restaurants, and the shake-up is clearly hard to miss in these segments. My colleague Anjali is bringing you a roundup of all that's been happening in these two industries, and then we'll be joined by Karan Taurani, who's a senior EVP of Elara Capital, to decode this play that's in store for Rapido and BigBasket. Anjali.
Well, let's start talking about first the food delivery business, which is set for a major shake-up now that we have a couple of new players which have entered this space, starting with Rapido, which has now started onboarding restaurants on the new food delivery business in Bangalore, and it is expected to be launched by the end of this month. What is going to be interesting to watch out for here is the new commission model that this player is bringing, wherein there will be a flat commission that will be charged to the restaurants on the platform depending upon the order value. So any order under 400 will have a commission of flat commission of 25 rupees, and any order above that will have a flat commission of 50 rupees. Now this is important because this puts the commission charges on Rapido at almost half of what the competitors Zomato and Swiggy have been charging restaurants. Given the average order values, it would translate to roughly 8 to 15% of commissions for the restaurants as compared to the 15 to 30% that is charged by the competitors. But the other player that is going to be entering the quick food delivery space is BigBasket, which has made its plans clear that they want to expand nationwide by the end of this year, and they currently have 18 locations in Bangalore where these quick food delivery services are available on the BigBasket app. This plan on scaling to 50 locations in the next 45 days, and this is happening with the partnership of Starbucks and Cumin, both under the Tata banner. That's what BigBasket is doing. But there are also updates that are coming in from the quick commerce space, especially the regulatory hurdles that they've been facing. Zepto's Dharavi dark store had its FDA license suspended after the norms were violated and unhygienic conditions were found in their warehouses, and the FDA and the FSSAI have said that they are stepping up these inspections and surprise checks at dark stores and warehouses across locations, which would mean that this regulatory glare on quick commerce platforms is going to be stepped up. The FDA license was also the Blinkit store in Pune was found not having the right license, after which they received a stop business activity order as well from the Maharashtra FDA. So there is quite a bit of regulatory glare on quick commerce platforms. And also, if we talk about the partners, which is the delivery partners as well as the restaurant partners, gig workers for Zepto in Hyderabad have called for a strike, saying that they are not receiving adequate payouts, and it can be as low as 10 to 15 rupees per order is what the union is claiming. Additionally, if we look at how restaurants are also voicing their concerns, this is on the different fees. There was a long distance fee that was introduced, and also the increased ad spends is something that they've been calling out. So in all sense, there is a lot of activity happening in the quick commerce as well as the food delivery business, and it is ripe with action.
Absolutely, Anjali. The food delivery and, of course, the quick commerce segment, and now you also have the ride-hailing service as well. Well, all of some of those companies really coming together. On that note, let me welcome on the show Karan Taurani. He's like I said, the senior EVP at Elara Capital. Thank you very much, Karan, for joining us here on ET Now. First things first, what do you make of these two announcements that have been coming in from Rapido and BigBasket? Can you do a separate case-by-case analysis on both of these companies and their expected foray into the food delivery business?
Good evening. This segment is getting quite dynamic as far as the food business is concerned. We have seen entry of new players in the food business in the past as well. But the entry of Rapido is a negative surprise for the incumbent players. Because the earlier players have actually struggled on two parameters. One is capital. Most of them did not have access to capital. They could not discount, could not have their own app, could not invest in terms of scale, consumer experience, and the number of customers. But and the second big reason also has been access to last mile in terms of delivery, as they were dependent on third-party delivery partners. Now, Rapido brings both these propositions on the table, wherein they have got access to capital as well, because they've been getting for multiple rounds of funding. The company is valued at about $1.1 billion. They may even have future rounds of funding, which will actually lead to more capital infusion in the company, which means that this potentially can be used to disrupt the market in the form of discounting. It can be used to gain more customers, and maybe also have some kind of a war in terms of take rates. So that's the first thing. Second, of course, Rapido runs a large fleet of more than 4 million riders across the country. If you look at Zomato and Swiggy in terms of the number of riders that they have, it's about 0.4 to 0.5 million. So basis that, they've got a very large fleet of riders as well, which means there's a very good last mile control. Third very important thing to watch out herein is that restaurants will be more than happy to have a third aggregator partner. So because of this entire duopoly between Zomato and Swiggy,
Yes.
Since so many years, restaurant partners are the ones which have seen the shrinkage in terms of their profitable margins. Because if you look at take rates or commission rates, they have seen a significant increase over the last 3 to 5 years because of the dominance of Zomato and Swiggy. So they'll be more than happy to kind of have a third aggregator in the system, which means even take rates can potentially come down. So a lot of disruption is there. Potentially Rapido can kind of really disrupt this market and really harm the incumbents in terms of both growth and profitability. The only big key here to watch out is execution. So as I said, we have seen players in the past come into the food delivery business, but they haven't been able to do well. So execution is a key here in terms of what Rapido exactly does. Why would a consumer be propelled to use, a Rapido app versus a Swiggy Zomato app? What is the kind of user experience they can offer? What is the kind of pricing they can offer? What are the kind of lead time and delivery they can offer? I think this is the major silver lining which will decide the future of Rapido in the food delivery system.
Absolutely, Karan, very rightly put. In fact, the NRAI, with respect to its issues related to these some of these food aggregators, Zomato and Swiggy, it has raised that issue multiple times with respect to them venturing into the restaurant delivery space, and they say that their understanding with these companies was rather different. But a brilliant case that you've made for Rapido, of course, to get into the food delivery space, and of course more number of players certainly, Karan, means that there will be better pricing for consumers. What kind of packages do you expect for consumers to be given by some of these companies that are present in this food delivery space? Because we've seen several social media posts that have come out wherein users have compared on how much a food item costs in a restaurant versus how much they cost on these platforms, and the difference is quite big.
It's exorbitant. I think if you look at ONDC, when they came in, they gave steep discounts. Similar thing is happening with Rapido as well. They have made inroads in the market, and they too are giving steep discounts. Now, the discounts or the AOV is down because of two reasons. One is, of course, there are promotional offers which are being pushed by the new players, wherein they are not charging platform fee, they're not charging packaging fee, they're charging a lower delivery fee. Second, of course, is the restaurant commissions as well. So if you look at what Zomato, Swiggy have done over the last few years because of the sheer dominance, there is a different pricing when you consume the food item in the restaurant, and there's a premium pricing when you order the same food online at your house. The difference between the price is anywhere between 20-25%, which means higher take rates as well. So I think all these things will see some sort of a revamp, at least in the early days, at least in certain cities like Bangalore and other places where Rapido is trying to make inroads and is trying to launch. But that is how the consumers will kind of move from one platform to the other. this category right now does not require too much of an investment in terms of awareness. So thankfully for Rapido, had they come into this market 5 years ago, they had to invest very aggressively to create the category, build awareness, build discount, build promotions. But there is already a set customer base for the category. People are used to ordering food online. People actually know about in terms of what is the convenience, what exactly is this proposition. So Rapido's job has actually become slightly more easier here. So I think they can just, propel discounts, try to persuade the restaurant partners and, lower their take rates and maybe have a win-win here. But again, how do they differ on lead times? How do they differ on consumer experience will be the key factor if they want to really scale up. If Rapido were to be just one other player and probably in the next 3 years, if they get to 3 to 4% kind of market in the food delivery market, it won't dent incumbents like Zomato and Swiggy. But let's say if Rapido ends up scaling up to a 10-15% market share in the next 3 to 4 years, this will have a definite negative impact as far as growth rates are concerned and profitability is concerned, both for Zomato and Swiggy.
Right. So, Karan, you've touched upon a very important point about profitability, and I'm going to come to that. You've built a great case so far as Rapido's foray into this segment is concerned, and it's going to be beneficial for consumers as well, because some of these, fees by these companies, Swiggy and Zomato, most importantly, whether it's your convenience fee, whether it's your service charge, and then there is handling fee as well. All of these fees have only increased in the past very many months, and of course, consumers are forced to just stick to these two options. But there's going to be more options, and more options mean, better the offer for consumers. But let me ask you about, low margins. Well, food delivery as a business has low margins. Can these companies really build a profitable model here, or are they going to burn cash to gain ground? You did mention about, how Rapido has enough cash to burn. But what about, perhaps after 2 years, what about BigBasket?
Firstly, from a Rapido standpoint, we actually don't know in terms of what is the current cash. It may be somewhere close to $150 million, basically last fundraise. But I don't think that is enough. They will require much more amount of cash to burn over the next 12 to 18 months, which means a further fundraise is possible. But as I said, they might try to rationalize some of the metrics here, rationalize platform fee, rationalize the take rates from the restaurants, but they can't go in terms of blanket discounting, because if they go in terms of blanket discounting, eventually, they may not see fresh infusion of capital. The valuations might see a negative impact for someone like Rapido. Now, take the case of Zomato and Swiggy. At this point of time, when both these companies are listed, they will also struggle to discount beyond a point, because the listed companies, investors give them a premium valuation multiple, primarily because they are duopoly, primarily because they are making reasonable amount of profitability, and there is a trajectory here for the profitability to improve from here on. So if they discount beyond a point, this will have a big negative impact and dent in terms of the overall food valuations for Zomato, Swiggy, which is why they can't, discount beyond a point. So Rapido should not depend on purely price war. They should try to rationalize the ecosystem in terms of take rates and have a very big focus in terms of consumer experience and lead time. As I said, why will a consumer move from a Zomato, Swiggy to a Rapido? That's the first thing. Second, in terms of BigBasket, making inroads in this segment, I think they are trying to make inroads in the quick food segment. Now, the quick food segment is still very small. If you look at the offerings like Swiggy, they've got bold snack. There are multiple offerings which are there. But these are food segments basically, which is very small in terms of market. So for someone like Swiggy, the quick food segment is only 10% of the GOV. Potentially, it can go up to 15-18% of the GOV. But there is nothing new over here. So these are basically the food segments wherein the food is kind of prepared in nature. It could be, sandwiches, coffee. It could be fast food. It could be food in the likes of, cake shops. So these are things which are already present. These kind of food items were delivered between 10 to 15 minutes. So definitely BigBasket also making inroads in this ready-made food business, probably also launching their own food brands, may have a certain negative impact for the food tech aggregators. But this will not be a big risk as such, because the quick food segment itself is very small as a category in terms of overall GOV contribution. Because if you look at the various food items, like if you look at biryani, burger, pizza, and so on and so forth, these items cannot be delivered within 15 minutes. So there are only certain ready-made category food items which can be delivered within 15 minutes. And that is where BigBasket is entering. So the dent will be far more smaller. So I think Rapido here is a bigger threat as compared to what a BigBasket would do for the food delivery segment.
Right. So Rapido, you think is going to be a bigger threat for some of these players, these two players, Swiggy and Zomato. But Karan, let me also take you through this brokerage note that we've received, and it essentially says that this is going to be a difficult one for Rapido, given that the food delivery business is a complex operational business. It also says that incumbents are at an advantage. India is a fragmented market, and secondly, they also say that at low contribution markets, the flywheel just doesn't work. How do you respond to that note and those claims that have been made with respect to Rapido's entry or the purported entry?
So I think, firstly, in terms of the tying up with restaurant partners, we don't see that being a concern. Obviously, it'll take time. I mean, the kind of restaurant network Zomato and Swiggy have built over so many years, Rapido might take 18 to 24 months to build that kind of network, or probably go on par with that. But we don't see that being like a huge concern. The concern we see for Rapido is, as I told you, one is in terms of the app user experience, and second big concern is around cash. So today, let's say if they have $150 million of cash, and let's say they're able to use this for, let's say 6 months, 9 months. After that, will the investors back them, for further infusion? And will they be able to raise that kind of money at a on par valuation today, what Rapido is, or maybe a higher valuation? That is a big question mark. Because investors right now, the PE funds, the VC funds have become very vary in terms of backing businesses which are strong in terms of user experience, backing businesses where the customer is sticky in nature. We are not in that zone anymore of experimentation until about 5 to 7 years back, wherein all these companies just came out in the market. There was ample liquidity. These companies raised capital. They were trying and testing things. We are away from the trying and testing phase. We are now in the phase of consolidation. We are now in the phase of focus on profitability. So Rapido will have to show a path to profitability if they were to sustain this. Now, the way they are entering this space right now with zero platform fee and zero packaging charges, lower take rates, we really have our doubts in terms of how will they actually end up making money in this. I think initial days the losses are going to be pretty much hefty over here, but they really need to crack the code in terms of how they're going to improve unit economics, how they're going to create a path to profitability. So let's say today, hypothetically, Zomato or other e-commerce companies, Zomato and Swiggy, are doing an EBITDA as a percentage of GOV of 2.5 to 4.5% roughly. And let's say if the entry of Rapido, they are able to generate 1.5% EBITDA as a percentage of GOV. That could be looked upon as a reasonable number, because that will be disruptive for the incumbents. But if they continue to make losses in a hefty manner, I think that won't augur well both for Rapido's future and for the investors who are wanting to back Rapido. So some showcasing of path to profitability is very important for Rapido if they were to sustain the food delivery business.
Right. But Karan, how long does it really take typically for a food delivery business to break even?
So it actually depends in terms of what are the kind of charges you are going with. So let's say if you are charging premium take rates, you are charging platform fee, delivery fee, it could take anywhere between 12 to 15 months, given the current scenario today, to actually reach a break-even point or even attain profitability. But if you are going to rationalize your platform fee, your delivery charges, your take rates, it could take more than 2 to 3 years as well. And all these factors also depend on scale. Let me tell you, it is not just profitability. You can't have Swiggy, Zomato are very large in terms of the order volume and order traffic. I think Zomato alone is doing almost about 80-90 million orders. So I think if you have to really have a large scale as well, you can't just operate at about 5, 7, 10 million orders and expect some kind of profitability. So operating at a large scale, even if margins are squeezed on a per order basis, it's fine. But if you operate at a large scale, you are able to make reasonable amount of overall profitability in terms of absolute money. So scale is extremely important for getting profitability. Even if you were to say that Rapido will generate maybe less than half of EBITDA margin as compared to what Zomato and Swiggy are doing today.
Right, Karan, a very interesting analysis of what's in store for the food delivery business, for the food delivery segment, both for companies and most importantly for consumers. Well, Rapido has taken a very serious bet into the food delivery space, but it all boils down to how will it be able to provide differentiation when it comes to the overall experience for consumers to wean away from the already existing apps. Thank you very much on that note, Karan, for joining us here on ET Now and sharing your analysis on this segment.